Hello, I'm Tony Kaye. Welcome to the Economic View. I'm joined as always by Evan Lucas, our market strategist.
Hello, Tony. How are you?
Yeah, very good, Evan. Now, Evan, the latest numbers just come out on the CPI. What concerns me is what we're seeing with utility prices. They're just going through the roof. I don't want to turn this discussion into anything political, but it's a major problem for the economy.
Yeah, it's bordering on it. Look, happy CPI day, as I call it. Just very quickly on the headline numbers, they were weaker than expected. So there was growing belief by economists we'd actually touch the 2% band that the RBA is looking at, both on a headline and on the trim mean basis. But I agree. Let's start with what's going on in the utility space, because that is an absolutely staggering figure. It's why I've got it printed out, because I want to read it out. So having a look, if you have a look at what happened in the June to September quarter, you saw an increase of fuel consumption by 12.5%. For fuel consumption. Electricity was 10.5%, water and sewage 2.9%. But then if you look at on a state basis and looking basically into the capital cities, Adelaide saw an increase of 14.2% driven by electricity. Canberra saw a 12.3% increase driven by gas. Perth 7.5%. Then the rest of them realistically are fairly flat. So
just massive numbers, aren't they?
Massive numbers. And you know, there's a chart here that you can see the largest increase in electricity and utility subgroup in inflation basically as far back as 2010. I mean, that's a huge figure. So again, that's in headlines. So, you know, those energy, fuel. Other thing that was quite interesting was having a look at tobacco and alcohol. That added quite a lot on the headline figure. But, and getting back to what's going on at the moment, we saw a quarterly update from Wesfarmers today with Coles. If you have a look into this, it backs up what they're saying, which is that food and food prices is deflating. So food in this was actually going backwards. It declined by 0.9 of 1%. They were telling us that from their Coles numbers. So that all makes sense. So you've got to strip that out. Having a look at the trim mean basis, which is what the RBA cares about in terms of whether or not they're going to move rates, it also declined to 1.8% year on year. If you have a look at quarter on quarter, 0.4, expectations were for 0.5 for trim mean on quarter, and for 2% year on year, going the wrong direction. If we didn't have housing, it'd be even worse. And that's what I highlighted last week and in the Market Watch this week, was that without housing at the moment, core inflation is dead flat. Normally you see it coming through things like education and health. They too are not moving, which is a really interesting figure. But the political football, and let's not try and get too political, is clearly utilities. And that will be debated now for quite a while, because clearly they are out of control.
Yeah. As you say, there's no way that rates are going to move under those conditions.
Yeah, not now. And having a look at the initial reaction, Aussie dollar fell. And having a look at expectations around the interbank market, which is the swaps market that prices in the probability of rate movements, it was a certainty, according to the market, by November next year. That's been pushed out. It's now fallen away to 80% chance by November. June was about as close as you could get with 46, and that's fallen down to 42. So that is normally, from my perspective as a market watcher, that's more of a hedge. That's just the market just putting a hedge position in there just in case. Realistically, it's telling you it's unlikely. In fact, it's very, very unlikely. Inflation's going the wrong direction. So really interesting figures. It's why CPI, I actually believe, was probably the biggest piece of data that we were going to have in the next few weeks, because it has been quite an optimistic period. We have been seeing expectations of green shoots. Financial stability is the core word, and I will probably highlight that. There is still a chance, because the RBA is worried about financial stability and home loan lending, etc. But their core mandate is still maintaining inflation between 2 and 3%. We're not getting there.
Now, in terms of the utility prices, I mean, that's going to flow through to everyone really in the economy. So on the one hand, you've got that really spiking, you've got food prices coming down. So they're offsetting each other, but it's going to be a problem.
Yeah, and getting back to what we've talked about many times on this program is, if you have a look at consumer confidence, despite the last figure showing that it broke out of pessimism, we were optimistic around job security. The biggest core issue that the household talks about is the fact that prices are there, and energy is a big part of that. The survey they had of household expenditure about 6 weeks ago showed that just shy of 60% of your weekly earnings is going to basics, and energy is a big part of that. So utilities are going to now become quite an interesting thing. And again, trying not to go political, next year's a big year. There's state elections, there's also a federal election next year. And this is clearly going to be a thing to watch. So from a market's perspective, it's an interesting point. From a political perspective, it's an interesting thing. What does it mean from what we look at, which is monetary policy? Clearly means the RBA is probably out.
All right, Evan, we'll leave it there for today.
Thanks, Tony.
Thanks very much. Thanks for joining us on The Economic View.